Record on this computer. All right, so let's get back to it. So I talked about the first macroeconomic factor that influences the direction of the market, which is inflation. Inflation is separate too, and core price index is separate. So I'm sure you guys have heard about NFP, which is non-farm payroll. We're going to talk about that one too. We have inflation, we have CPI. So these things you have to understand them because they affect. These are the fundamental economic factors that affect the movement of price in the markets. You know that in Nigeria now, when as the rate is high now, it's affecting everybody. It's affecting the fuel. It's affecting when you go to BAB, everything you try to get, the price are going up. So that's how it is in the financial market too. So inflation, let me take it again. Inflation is the degree of percentage rise of goods and services. Inflation meaning that if goods and services prices are high, meaning that there is inflation. But when it's down, it's called deflation. When the percentage price of goods and services are low, it's called deflation. So core consumer price index is the percentage rise of an average weighted price of food basket of a household. See, that means that the average price that people in a household get is the core price index, consumer price index, meaning that the money that costs the person to go get a finished good from the seller, because as consumers we are at the end of the trading basket, that cycle of food. Sure, we've done that in our school. All those on even concern us right now. Our own is to understand how these things affect the market. Mute yourself, please. Tiny. Mute ara ẹ. Okay, good. So now let's move forward. While inflation captured the general increase of goods and services, CPI captured the degree of increase of household commodities required daily by families. Do you understand that? If you don't understand, let me come again. Why inflation captured the general increase of goods and services, meaning that when price of goods and services in our country now goes up, there's inflation. When it comes out, there's deflation. CPI captured the degree of increase of household commodities. Household commodities are talking about those things that cost you daily. When you go out to go buy fuel, those are your household commodities. You get me now? That's consumer price index. That's how much it's charging you to go outside to get stuff. You understand? Those are household commodities. When you get a new chair in the house, or you get a new fridge, those kind of stuff are household commodities. You feel me? So now, when inflation and CPI number goes up, most individuals have less spare money to invest, meaning that when this stuff, like when the price of goods and services goes up in our economy, we don't spend much because now we cannot afford it. You understand? You're spending more for what you used to get as a lesser price. So there's less money for you to spare. There's less money for you to invest in a business if it's too cost. You understand? But when it goes up, it favors the dollar. Do you understand? That's what it says here. This results to decline in stocks, equity, and crypto, while the DSY goes up. Consequently, decline in CPI and inflation numbers causes more money to spend, which leads to increase in stocks and consumer market, but decline DXY in most cases. Meaning that now, when it costs you less for you to get goods and services, you have more money, you have spare money, because something that could have cost you about, we know the new dollar rate now, which is $1 is equals to 160 naira. Something that used to get at $1, which is 160 naira. If it's now the dollar comes down to, like, let's say half, 800 naira, you can be able to get two of those things. Meaning that you have 800 naira extra if you get that store for 800 at the dollar rate. Meaning that now the dollar goes down, which makes you have extra money to spend. That's what it says here. So consequently, decline in CPI and inflation numbers causes more money to spend, which leads to increase in stock and crypto markets, but decline DXY in most cases, which leads for there to be extra money for you as a consumer to invest. If the CPI is up, if there's inflation, you have less money to invest. If the CPI is down, you have more money to invest. That means you can also invest in the market. So those are stuff. But we forex traders, we traders in a whole, those things favor us if we know the right direction in price or in market to really trade. It favors to and fro, but also every trade you take costs you a dollar rate to put price in the market. So it costs you money. That's all about. Now let's move to the next one. We have interest rates. Interest rates, this is the percentage amount a lender charges the borrower. It is the charges, the chargeback, it is the charges banks place on loans to investors and individuals. Meaning that when we know Lapo now, everybody don't know Lapo. Mom C, auntie, uncle, or your friend who you sabi, you go collect loan, those kind of stuff. So that amount that they charge for you, that amount that is charged for you, that a lender charges the borrower, you that are borrowing, someone that is borrowing you, the amount that they are charging you is the interest rate. So that's that. Interest rate is also the amount bank gives to those who save money in a savings account, meaning that when you have some certain amount of money in your bank account and your that money is like an investment, that money you're leaving there, the interest that they are putting on top is the interest rate. So the higher the interest rate bank charges on loan, the less people want to get these loans. Meaning that if a bank charges you higher, if a bank charges you higher interest rates, there's a likelihood that you will not want to go and get loan. And the less money available.
Recording in progress. Recording in progress.
Hello, kindly mute yourself wherever you are. Thank you. Please, if whenever you come, yeah, there are times where I will say, okay, there's time to ask questions. Then we can all open our mics and interact with each other. But when it's time to like teach you, listen, because the way I am also really going through all of this is also helping me, remember things too. You understand? So it's not everything I can put on my head. I'm sure most of you guys feel, probably you guys have not been trading yet, feel trading is just you come into it, you learn strategy. No, you have to learn all these details. It's reading. You have to read, 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 read. You are learning a course. This is what trading is. You're learning a full course. Something like that's why whenever I advise people who want to come into trading, I let them know that the way you go to a university to learn a course for 4 good years, yeah, it's the same way you come into trading and say, okay, you want to take your time to learn, you want to really take your time to understand what forex trading is all about. Because without main understanding, without really knowing what it means, I'm not sure you really be profitable because the goal, like I said earlier, is to make more profit than the loss that we incur, which is the cost of doing business. So let's continue. So the higher the interest rate bank banks charge on loans, the less people want to get this loan and the less money available for spending. Hence, stock and crypto will suffer and DXY increase. Meaning that if there's an high interest rate, yeah, the dollar will increase. Meaning that if and also the lower the interest rate, the more money is available to the economy. Meaning is the economy are the masses, the economy are we the people, the citizens. So if there's low interest rate, there's a liability that you can go and borrow at a low interest rate, meaning that okay, now you have money available to spend, and that's contributed positively to equity and crypto markets. Why the DXY weakened. So whenever, like I said, whenever I see DXY, I know that you're talking about the US dollar, US dollar index. So now, whenever you as you start trading the news, whenever you start trading the news, when you see you will learn more about this, you will see more about this interest rate, inflation, CPI, and all of them. So now you're moving to the next one, employment rate. So employment rate affects financial market. The more people get involved, the more the spending power, hence financial markets are favored to the upside. Let's take that again. Employment rate affects financial market. The more people get employed, the more the spending power. Hence, financial markets are favored to the upside. That means the more people get employed, the more they get paid the salary, the more they have money available to spend. So it favors the financial market to the upside. Also, when employment rate goes down, meaning that less people are being employed, there's no job. Like we're going through in the Nigerian state now, people don't have money. That's why they want to come out and they want to protest. You feel me? So those kind of stuff, yeah, will lead to the financial market going down because of the low spending power. People don't have money available to spend. They are saving their money because they have to use that money to survive. So the next one, we have money supply. Increase in money supply via central bank printing increases money in circulation. This helps to inflate equity and crypto. However, reduction in money supply causes less money and hence I don't really use all this money supply, quantitative easing, tapering. I don't use that. All these are mostly what's it called for stocks and whatnot. They are not for crypto market. But let me just read them out. Quantitative easing. Quantitative easing is a monetary policy used by Federal Reserve or bank to increase money supply. Okay, so this Federal Reserve now, once you really dive into trading and you're you don't really like forex and you want to switch to another different financial market, you will come um as you will come to meet Federal Reserves on the way. Central banks, you'll be hearing those type of fundamentals. So, right now you're talking mostly on the macro economy. So and how they affect the US dollar. So let's move forward. This often results to increase in equity, other foreign exchange and crypto while DSY suffers. So that is that. So now trading ergonomics. Trading ergonomics is the art of designing and arranging the things used in trading in such a way that the trader's comfort ability to trade is enhanced. What it means is that now everything you're going to be learning, yeah, everything you're going to be learning is trading economics. You're going to learn the things you need to trade comfortably, the things you need to do when you're trading, the way you're supposed to act, those things you do. It's not trading is not all about your strategy. Trading is all about your has to do with your psychology. It has to do with your money management. It has to do with when in the day are you going to trade? When are you supposed to trade? When are you supposed to come to trade? You're gonna come across market sections. You're gonna learn about trading plan. Or you have to have a trading plan that guides you when you are in the market because trading gives us gives us a wide vast opportunity to make money in the market, but also it gives us a wide vast opportunity to lose huge money in the market because trading anybody can be a trader, but only a few one there's only 1% that gets to that profitability stage, meaning that you're making consistent profit. So that is the goal to make consistent. Everybody can trade, but to be a consistently profitable trader, you have to learn the right way. You have to learn the skill. You have to develop the skill, which takes years. Like for me, when I first got into trading, first 3 months, I thought, okay, cool, I will be having that Lambo dream. But to God, I don't tire, but give up. So let's move forward. So trading ergonomics assesses the trader's emotional and mental states, condition to ensure they don't impact negatively on trading results. Meaning that if you're feeling down, it's advised not to trade in the market. If you're too busy, you're advised not to trade in the market. Your environment also is advised not to trade. Those kind of stuff, those kind of factors are what we call the trading ergonomics. Trading ergonomics, that's what trading ergonomics is all about. So trading ergonomics also examines the trader's convenience and physical state that allows efficiency and high performance. Like me, I've learned that whenever I'm not on my laptop and I'm looking at the charts on my phone, if I'm not on my laptop and I'm trading outside of my trading space, like I'm not settled, I'm too busy. I will not really get to see the clear thing. That's why I'm advising for a trader, you have to have good network. First of all, if you're dealing with stress, don't trade. If you're too busy, don't trade. If you're not feeling good emotionally, don't trade because your emotions will come and affect your style or the way you're trading. So that's what I just said is what we're going to talk about now. Now, do not trade when dealing with stress. When stressed, either physically or otherwise, stay away from the market. Stress impairs right thinking, which leads to poor decision making in the market. The market will remain and chasing it with a drained energy will result to bad trade. Like me now, that was what happened to me today. I was already stressed, like when I started over risking till I got my account blown, my prop firm account blown. So that is that. So do not day trade when too busy. Trading requires proper attention. When you are very busy and occupied with other matters, stay away from day trading. Unless you've like done your breakdown, your analysis on your laptop before heading out, or you've done it on your spare time and you're looking at it on your phone, then you see that price gets to your place, you wait for your confirmation, your entry confirmation, then that's when okay, you can say you just want to take a trade because you've done everything you need to do and you just have to watch it on your phone. That's all. You get me? But when you are too busy, don't trade. You don't want to get you don't want to be trapped in the market as a result of not remembering when you have an open position or taking trade rashly because of busy schedule. They said here, do not trade with poor network. Trading the market could be very volatile and fast, and good internet service is needed for good trading performance. It happened to me severally where I may be on a trade right now, or a news event is about to happen, and then MTN, like what everybody has been going through now, MTN will just take their network. I may have not have put my stop loss well. I may be in profits. News will just happen. Bam, have passed my stop loss price. I've lost money that I actually intended to. I've lost the amount that I'm actually willing to risk. Then it affects me psychologically. Then I come into the market and I want to revenge trade. Those are the things that you have to. Those are the things you will deal with as a trader. So these things I'm telling you now are the things that I was not told. Like we were told, yeah. I will not lie, we were told, but like until you experience before you understand. They say experience is the best teacher. That's it. So experience is the best teacher. So now let's move to the next one. So how to trade. How to trade is the technical use of data from price behavior to predict future price direction. That's what price action is all about. It is the interpretation of price actions, like I said, via the use of candlesticks and chart patterns to suggest the future move of the market. How to trade is based off on the knowledge of this, which is your technical analysis and your market psychology. So let's go to what technical analysis now is all about. So technical analysis is the use of previous price behaviors, data, and indicators to determine price movement and direction of the market. So now this technical analysis, for beginner traders, yeah, for beginner traders, we believe that once you have the perfect technical analysis, you make money in the market. That's a big lie. There's no holy grail, there's no holy technical analysis. Everything works. You can see that there's a technical analysis that have a win rate higher than the one that you may have known or the one you're going to know along your trading journey. But trading also is a 50-50 type of thing. It's just like this. When you flip a coin, like you have a coin which has heads and tail. When you flip it up, you're not certain what comes out. You know it in your mind that it's 50-50. You don't beat yourself up about it. But now, why do we beat ourselves up about it when we are in the market and when there is 50-50? Because technical analysis gives us an edge in the market, which puts the odd in our favor, which gives us an idea of what is going to happen next based on um, previous price data. But now, in the market, you can never know what is going to happen next because no matter what happens, there can be a news event coming up, and yes, the market may be going in your direction, yes, but then that news will affect and take you out before it initially goes in your way. So those are the things. That's why risk management is so important. We're going to really go into that risk management part and all those things that make up a trader later. This PDF is just to take you on about everything you're going to be learning along the way. So, like I said, technical analysis is the use of previous price behavior, data, and indicators to determine price movement and direction of the market. Like I said, I'm sure you've heard since that everything I'm talking about is price, 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 because the currency you're going to be trading has a price. Everything you are looking at the price. You're looking at the price. You're looking at the price. When you go to banks, those are what banks looks at. They look at prices of a currency. They look at the exchange rate, like the Nigeria exchange rate now to the US dollar now. That's the price. You understand? Those are the things the financial market is. So we in technical analysis, you have to understand candlesticks. Candlesticks are very important. Japanese candlesticks. Now, Japanese candlesticks are graphical illustration of price changes and direction. It uses candlestick to illustrate price, and each of these candlesticks tell a story based on how they form. Candlesticks consist of a body and a wick. The body represents the area between the open and close of the candle, while the wick represents the area outside the open and close of the candle as seen in the diagram below. So each candlestick is price subjective. They give an idea of what price is doing, and they could indicate an up move or a down trend move. Meaning that these candlesticks are what we use to know who is coming into the market. Let's say now you are in an uptrend, you have to know who is coming, like whether you're going to be buying or whether you're going to be selling. So that's what we use candlesticks for. So I have a PDF, a candlestick Bible. I will be sharing to those who want to read it. You have to, like I said, trading is all about reading. You have to read, 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 read. So you will read it, then you have to read it, understand it. Read and understand candlestick Bible. That candlestick Bible, when I knew candlestick Bible was when I actually started taking trades for myself. That's when I actually started taking trades for myself. When I learned first, I learned my first month. I did not really attend the class. You feel me? The course I got the course. I was reading it. I was learning, and I thought, okay, good. I've learned. I think I know this thing now. I took a trade. I took a signal, not my personal trade. I took a signal. That was Abby sent a signal. I took it, and I made like $5. I was like, okay, good. I don't sabi. I went to go and take another signal. That money, I took it to another account that was synthetic. When I got there, I blew everything. I was like, okay, good. It's like I don't know this thing. And I went back to for another time. I've started forex trading. I started forex trading last year, February. So last year, February, this January, February, let me see, February was when I registered. February, March, April, I did not really go there. I was just really learning, 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 learning. I took a loss using Signal before I now went to actually for the class, for the physical class. I went again, to go and do what I did not do. I paid attention. That's why every detail, every class I'm going to be having, if you really want to get knowledge to help you grow in forex trading, be present. This videos I'm doing is this class I'm doing is to help all of ourselves grow. You understand? So that's it. You really need to study, you really need to learn. So bullish and bearish engulfing candle. So these candlesticks are very common. Bullish engulfing candlestick is signifies a buy market. Bearish engulfing signifies a sell market. So bullish and bearish engulfing candle. Now let's talk about bullish engulfing candle. Bullish engulfing candles happens when a candle body closes above the previous candle. It usually signals a buy, especially when the engulfing candle is a breaker candle. I understand that this English is big. Yeah, I'm running out of time. We go far. So this bullish, this candlesticks, I will send the candlestick Bible. You guys are going to go and read about it. So when you guys have read about it, yes, then I will now come and explain to you guys what I have on the topic. So there we have hanging hammer and hanging man. This one is also common. I use it most of the time. We have inverted hammer and shooting star. I use it most of the times. We have doji and gravestone. I use it most of the time. So all these names that you're seeing, this from this hammer, this inverted hammer, and this doji, they all look those three looks they look the same. You just have to understand what they mean. That's why you need to read the candlestick Bible so that you understand what they mean when you see it on the charts. You get. So now let's see candlestick formation. Candlestick formation is the combination of two or more candlesticks. It gives solid information of price changes and more detailed than a single candle formed, meaning that you have to have multiple candlesticks come together to know the direction of the market. Examples are tweezers, morning stars, and evening star. And since tweezers, they have their meaning. Morning star and evening star have their meaning. Look, evening star has its meaning. So I think we're done with this. Everything on this PDF. So great. Sorry, please, can we get the slide after the class? Do you mean the PDF? I will send the PDF to you guys. I'll send the PDF to you guys. You have to take your time to read it. The PDF basically talks about the strategy. Like it breaks everything down for you. But now, yeah, I think you're done with this for today. So, but now in forex trading, let me do a quick in forex trading. Yeah, you have to have live chat experience. This chat now that I'm going to be opening for you, you need to spend time there. You can know the strategy by mouth, but if you don't know how to apply it on the charts, I have this already read it 168 pages. That's very good, very good, very good. Those of you who have not read it, I'll send it on the group, and then we move from there. So these are what we're gonna be. This is the strategy I'm going to be teaching you guys. So the strategy talks about how many more minutes do you have? The strategy talks about the first one of all. The first one of all is the trend line. The trend line is the most important factor in my trading style. You must learn how to use the trend line. The trend line strategy. That's what my strategy is about. Trend line strategy. That's what I call it. So trend line strategy is used the trend line, let me type it out. Trend line. Oh, sorry. I'll have this. Sorry, okay, now. Okay. Are we still together or is my video down? Okay, let's see. You cannot minimize Zoom when you are recording. Okay. So, we're going to be talking about trend line. Please, if you're still with me, signify in the chat box. Trend line, support and resistance, support and resistance. Um, how to use them, how to use Fibonacci, how to use chart pattern, and how to use the candlestick pattern. So these things are what you look for when you come into the markets. These are my criterias. These are what I use when I come into the market. And mostly this support and resistance, we're going to be dealing with psychological levels. These psychological levels now give you precise points in price to either buy or sell. So this is the concept of the strategy I'm going to be teaching you guys. Why I'm doing this is because I want it to be a community where we can break down a chart together. Then we uh, give our view on what is going to happen. Then we build confidence from there. We grow together because doing forex alone is frustrating and not easy. If you're not with a group of people or group of traders, you start having doubt in yourself. You start doubting what you can do. So those kind of things, and this are the concept of what you guys are going to be learning. So why is this thing still on? It's not supposed to be off by now. See how many? Let me check charts. I haven't seen your screen. Have you project? See, recording. Um, Zoom meeting 40 minutes. Let me see. I think, I think, I think this stuff here. I think the sharing screen stuff got out. It got cancelled though. Got cancelled. Guess. It got cancelled. Screen loading. So you know the essence now. Wow. So this stuff here. Yes, you guys can see now. This stuff here. Trend line is what we're going to be learning about. Support and resistance, especially psychological levels. Well, we are going to be dealing with Fibonacci, chart pattern, and candlesticks. So now, the trend line is used to help support your understanding of the market structure, the market cycle, whether it's uptrend, downtrend, or consolidation. You have to understand the market cycle first of all before you can know when to use your trend line. Then when you understand the trend line, you have to understand the levels. Support and resistance are levels where you buy or sell from. So whenever you hear support, know that you're buying. You want to buy from there. Whenever you hear resistance, know that you want to sell. So supports are where buyers come into the market, resistance are where sellers come into the market. So now Fibonacci, it's a tool used to check where price is going to retreat to. Chart pattern is a pattern in the charts that tells you whether buyers or sellers are coming into the market. So an example of a chart pattern is this. Like this chart pattern out here on GBPUSD is a double top. This one here is a double top illustrating that sellers are coming into the market. So seeing this alone, we will tell you, okay, Market is in a downtrend. Also, you can also see one chart pattern happening here. Double bottom. This is the second leg now. The price wants to buy. The candlesticks are this stuff you are seeing now. This green now that you're looking at. It's called candlestick. This red candle that this